Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks hitting new all-time highs on optimism over AI momentum, and clearly markets not impacted by the turmoil in Washington around the government shutdown. We're digging into those stories. But right now, it's now to go until the closing bell. Let's take a look at the major averages. The Dow up about 316 points. Your broad gauge, the S&P 500, is up about 0.1%. Your tech-heavy NASDAQ is down about 0.3%. Let's welcome in here Washington correspondent Ben Werschkul and data and markets editor Jared Blickery joining us to break down all the headlines. Jared, my friend, let's start with you on the day's trading action so far.
We got a mixed market today, but we are looking at green across the board for the majors for the week. And let's start with the Dow, up 334 points, about 0.75%. By the way, in line with the Russell 2000. So the big guys and the small guys doing about the same thing here. And you can see we've been in the green all day long, but off of those highs. And then the NASDAQ has dipped into red territory since about the 1 p.m. hour, but only looking at a loss of about 0.25%. S&P 500 just barely green there. It's been a little bit red. Nothing to write home about. I mentioned the Russell 2000. Let's take a quick look there. Very similar to the Dow chart. And another thing is the S&P 500 equal weight. That has been hitting record highs recently. It's been a while, but that has joined the party. So that just means the rally has broadened out once again. And so let's take a look at what's going on in the bond market. After a couple days of falling yields, we are seeing the opposite here. We got the 10-year T-note yield up 3 basis points to 4.12%. 30-year is up 2 to 4.71%, and the U.S. dollar index is down just a little bit. Not that big of a movement there for the Dixie, as they call it. Now, here's the sector action. Utilities, that has been hitting record highs recently, hit another one today. Healthcare has not been hitting record highs recently, but it has been leading all week. And what's not working today is consumer discretionary, tech, and you can almost throw communication services in there. And if you've noticed, those are the 3 mega cap sectors. So we won't see a lot of green on the NASDAQ 100 board. Also want to point out that the value and cyclical trade doing pretty well. Financials and energy each up more than 0.75%. Now here's the NASDAQ 100. Looks pretty solidly, it looks like a mixed red, but more red than green. But if you sort by equal weight, and you can actually see there's more green here. So it's really the big guys that are weighing down this market right here. Palantir down 7%, AMD down 3%. To the upside, looks like Siri and Charter are leading about 3 and 4% each. But now the Dow is very much a green board. United Health, a healthcare stock, up 2%. Coca-Cola, Staples up 1%. J&J, Visa, each up more than 1%. The list goes on. Wanted to show you what's going on with the Dow transports. So we see a lot of confirmation between the industrials, which are making the stuff, and the transports, which are shipping the stuff, and not a lot of red here. And you can see some outsized performance by UPS and the railroads, Delta Airlines. Put it all together, and the transports are flying high. And I'll show you a board of red here. This is China, really not correlated to the US in any way anymore, but this, for your information, is a pretty red screen. And I thought we'd leave off here. We were seeing some weakness in banks earlier in the week, but not today. Here's the big banks. We see a lot of green here. Goldman Sachs, Morgan Stanley, HSBC, UBS, each up more than 1%. We'll also take a look at the regionals because those were suffering even more earlier in the week, but again, not today. So somewhat of a reversal of fortune, but we're just seeing broad strength for the most part this week, despite the shutdown.
All right. Thank you, Jared. Meanwhile, the Senate is wrapping up its 3rd attempt this week to avert a government shutdown. Ben has been following the story as the chamber undertakes this expected last attempt of the week. Ben, what is the latest?
So the latest, Josh, just a few seconds ago, the votes ended, and we have, as we expected, another 2 failures on plans to avert a government shutdown. Well, the way the Senate is operating here is they vote on a Democratic and a Republican plan. They've done it twice this week. They did it again this afternoon, and once again, both failed to reach the 60-vote threshold. The GOP plan that would have kept the government open for 7 weeks just went down a couple seconds ago. Most importantly here, there doesn't appear to be any changes in the margins here. This is comes as there's a lot of focus on moderate Senate Democrats and a Republican push to kind of get them to flip. These are folks like Senator Maggie Hassan in New Hampshire. They're not changing their votes, at least right now. These are exactly the same margins. The margin just now was 54 to 44. Two senators are out today, not voting. So it's exactly the same margins we've been seeing all week. Same positions. Three members of the Democratic caucus are supporting the GOP plan. So there is some Democrats wanting to end this shutdown based on that plan, but there's not any movement there. The overall sense here is one we've kind of come into focus today, which is that Senate's going to head home. Senators are going to leave for the weekend, and they're going to pick this back up Monday. Monday is when both the House of Representatives and the Senate will be back, and there's an attempt to sort of perhaps talk about negotiations. Overall, we're still in the kind of hardball stage here with the White House cutting Democratic programs. The latest one is Chicago infrastructure funding that Budget Chief Ross Vought announced is going to be on hold today. So they're still kind of at loggerheads. Nobody appears to be moving their vote, and now they're going to kind of have the weekend to cool off.
Ben, one school of thought I've heard is, when this will end, some folks say when the pressure ramps. And when will the pressure ramp? When the paychecks stop going out. What do you make of that?
I think that's a big one. Definitely, a lot of people have the 15th of this month. Paychecks are a little variable, but that's when military paychecks don't go out. So that's definitely going to be the point of it when it increases. I think there's going to be a lot of conversation next week, other ways that this could be felt. If there's a real turmoil at the airports, that's when I'm really watching closely. There's a lot of ways this goes. If the markets turn and start to actually care about this, clearly this week, as Jared just laid out, there's not a lot of attention on that. But if we start to see the economic effects, but I do think the paychecks are a good one to watch. Some federal workers will see their paychecks stop sooner, but the military is the big one, and that's on the 15th. And so I think if we're still in this shutdown on the 15th, that will ramp up the pressure significantly, no doubt.
All right, Ben, thank you. Appreciate it. Mm-hmm. Well, markets keep grinding higher despite shutdown chatter. Are investors flying blind? And could AI hype be turning into an AI bubble? Keith Lerner, Truist Chief Investment Officer and Chief Market Strategist, joining us now. Keith, it is great to see you as always. So obviously, Keith, we've been talking a lot about this government shutdown. Investors, Keith, have not seemed all too concerned about it. I'm interested why you think that is. What explains that reaction? Is there any kind of risk there, Keith? Any risk that we're being too complacent about all this?
Yeah, well, Josh, great to be with you on this Friday, and you're asking the right questions. I think the first thing is a lot of people are aware by now that when you look back at these historical shutdowns, and we've had 20 of them going back to the 1970s, the average market performance is basically flat. So I think, that's one thing that the historical guide. And then also, if we think about all the shift in narratives that the market has had this year, from inflation to tariffs to interest rates, the markets has become somewhat numb to the news flow as a whole. Again, and so then that leads to your second question is, hey, is there some complacency? Maybe on a short-term basis, but I do think that if I zoom out a little bit and I think about 3 months from now, 6 months next year, is this going to be the main story? Probably not. The main story, the North Star of this bull market, are profits. Profit trends continue to move higher. And I think really what's going to be most important for investors is this upcoming earnings season, which actually takes off in less than 2 weeks from now.
Keith, we didn't get that jobs report, of course, though, today. Does that give you any pause that, you don't have line of sight like maybe you normally would?
On the margin, it does complicate things, especially when there's this healthy tension between concerns about inflation and employment. But let's also recognize that the jobs picture, as much as it's the gold standard, we just had a revision of 900,000 jobs. So I think in the interim, the market is going to continue to look at private data. So we had the ADP report, which was somewhat slow. We did just get the JOLTS report right before the shutdown, which also showed some softening. And what you're seeing in the Fed funds market as a result of that is the market starting to price in 2 rate cuts by the end of the year. So I think the question also is the next Fed meeting isn't until the end of October. So the longest shutdown we had was about 34 days. That was the last one in 2018. So if we get closer to that and we don't get, the Fed doesn't have the reports, I think that may become a little bit more problematic. But I really do think that going back, more of the forward-looking guidance from corporations in a few weeks is going to be the most important, especially given where valuations are today.
Yeah, well, I wanted to touch on that, Keith, because you mentioned how profits are solid. But how would you characterize valuations, Keith? Because listen, you won't be surprised to learn. I don't hear strategists coming on the show, Keith, and telling me, hey, we look cheap at these levels.
Yeah, listen, I mean, to be fair, by any historical metric, we are somewhat rich. Now, we can say there are reasons for that. I mean, one example is if you think about technology and what I call technology plus, it's almost 50% of the market. Back in 1990, the technology sector was about 5% of the overall market. So the other thing that I think has happened the last 4 or 5 years is, our companies have been battle tested. As I mentioned, we had the fastest rate hiking cycle since the 80s. We had the highest inflation since the 70s. We had these supply side disruptions. And what have we seen? We've seen companies resilient, adapt, and I think the market is rewarding that as well. So yes, valuations are high. That typically has more of an impact on long-term returns. On a short-term basis, as we all know, it's hard to make a big market call just on valuations. And that's why I say, profit trends, which have been moving higher, which are also at an all-time high, has been the North Star. And that's why even though valuations are rich, we're still constructive, even though we do realize expectations are somewhat, elevated.
What do you make, Keith, as an investor, as a strategist, about this talk bubbling up of an AI bubble? There was this headline from Axios, I don't know if you saw this one, Keith, the biggest sign of an AI bubble is starting to appear, and they were really, in this piece, kind of talking about all the debt used for funding this AI boom. But what do you make of that, this talk of an AI bubble?
Well, we don't think we're in an AI bubble, but I think some of these things do show we're moving to another phase, and that kind of debt finance and some of the circular things that we've seen with Oracle and OpenAI, it does raise an eyebrow. But if we quantitatively look at the technology sector and compare it to the bubble where I started my career, I started my career in 1997. I lived through that bubble. When you look at a year-over-year basis for technology, we're up about 28%. So that's strong, but historically, even over the last 20 or 30 years, the red alert has been when we're up 75%, 100%. So we're not there. And then the other thing that we looked at is the kind of relative earnings trends of tech relative to the market. That's making new highs. That's different than what we saw in the late 90s, where there was a lot of companies that weren't profitable as well. So I definitely think there's some pockets of things that are bubblicious, but as a whole, we're still seeing the strongest earnings in tech. And again, going back on that year-over-year price appreciation, it's not really comparable to what we saw before.
So you're saying, Keith, bottom line, the stock market here, we're higher at year end than we are now. What could derail that, Keith? What would be on your wall of worries?
Yeah. So just one question, going back to the why we think the market likely moves higher, even if you see at least one more hiccup before year end. When you head into the fourth quarter after you've had strong momentum, so more than 25 new highs, the final quarter is up on average about 5%, and it's been up about 89%. So you have history as a starting point on your side. To your question of what would derail that, well, I think the main thing is going back to my main point. If profits are the North Star and they've continued to outperform, if we see moderation in that will be the concern. And we have to remember, last quarter, we had a blowout earnings season relative to expectations. Now, as we kind of move through a little bit later on the tariff flow and the consumer, we'll get a better read into this next earnings season. So I think that's the key. Of course, something can come from left field. That's hard to predict. So we're really focused, really on the main driver to us is profits.
Keith, always good to see and to have you on the show. Have a great weekend.
You too. Thanks so much, Josh.
Coming up, Federal Reserve officials are officially flying blind without key monthly jobs reports. Will that impede the Federal Reserve's monetary policy decisions going forward? We're taking a deep dive. Plus, we're exploring the future of the labor market and if that government data really is key while privately collected data remains available. Billionaire Jeff Bezos wants humanity to look on the bright side of an AI bubble. He's making new comments about the technology. That story and much more coming up. Well, the Federal Reserve is left without the September jobs report during the government shutdown. As the central bank faces an economic data blackout, this sets up a challenging road towards the Fed's next policy meeting. Yahoo Finance's Jennifer Schonberger joins us now with a closer look. Jen.
That's right, Josh. As a result of the federal government shutdown, the Federal Reserve did not get that all-important September jobs report today, arguably the most important piece of data that policymakers need to make their decision later this month. Given officials' concerns about a weakening job market over the summer, they really needed this report to discern whether that deterioration is continuing and what type of action they need to take if needed to stave off further deterioration, all as they are trying to balance the inflation side of their mandate as well, which remains a full percentage point above their 2% target. Earlier today, Fed Vice Chair Philip Jefferson called not receiving the report, quote, less than ideal, but noted that he never focuses on one single report. Rather, he looks across an array of indicators. And Jefferson noted that available data from both the government and the private sector right now show that both demand and supply of workers are slowing together when you look at the ratio of job openings to Americans who are seeking work. And indeed, if we looked at a measure of private sector data, the Indeed Jobs Posting Index, which is a real-time view of hiring demand based on millions of job postings on Indeed.com, that showed overall job postings fell 2.5% last month from the previous month. At the same time, other measures of private sector job growth show that payrolls are continuing to slow. ADP showing that private payroll employment fell by 32,000 last month. And Challenger Grade Christmas said that U.S. employers slashed jobs in September to the tune of 54,000. That's a 37% drop from August. And that employers are planning layoffs in the third quarter at the highest rate since 2020. And while private sector data is certainly not a substitute for the BLS jobs report, considered the gold standard, markets don't appear to be concerned that a lack of that government jobs report is going to throw the Federal Reserve off course for 2 more rate cuts this year. In fact, traders pricing in a nearly 97% chance of another quarter point cut at the end of this month on October 29th. Josh?
Thank you, Jen. Well, for a breakdown on the trickle-down effect of the government shutdown on what it means not only for the Fed, but also for businesses and households, let's bring in Conference Board Chief Economist Dana Peterson. Dana, it is great to see you. So, no jobs Friday, Dana. I'm curious, maybe start right there. What do you do as an economist in this situation, Dana? You know, you don't have that all-important government data. Do you feel like you're flying at least kind of partially blind here, Dana?
I think, yes, we are flying partially blind because government data are the standard. Again, there are private measures. We even have measures within our consumer confidence index and also for our CEO confidence index that gives you a view of how both consumers and businesses feel about the labor market. But still, no, that's soft data. That's feelings. The Fed needs to know what the reality is, and that's hard data. And I would imagine that if they don't have hard data by the time their next meeting happens, that they may just kind of sit there and do nothing.
Do you trust the government data, Dana? That's a question that's, raised in some quarters.
I do. And that's because it's not like one person producing these data. There are hundreds, maybe even thousands of people who contribute to the production of government data. You must have people who will go out and interview people, especially for the household survey. Those are interviews. You also have people who need to bring in the data, clean it, seasonally adjust it, make sure everything works properly. And there are also hundreds of people who are working on improving the data that we get. So I think the data are trustworthy, but as long as you have the resources, I think that we can continue to have trustworthy data.
Dana, how do you think this shutdown could impact the broader U.S. economy? How do you think through that question?
Sure. I mean, typically, shutdowns might cut anywhere from 0 to 0.3 percentage point off of annualized GDP growth in one quarter. And that's not very much unless you're like close to zero GDP growth, which we're not. And usually you get most of that back. Some of it you don't get back because you're not going to go and get two haircuts to make up for the haircut you didn't get before. And then also you have businesses that serve the government, contractors, or the person who runs a snack shop in a government building. Those folks have lost money and they're not going to get it back. But if this does persist, then we're probably going to see more disruptions across different industries like construction, housing, anything where you need a patent or a license or anything like that.
All right, so depends on the timetable. What impact, Dana, could it have on the labor market?
Well, this time it's different. It's interesting because typically government workers are furloughed, which means they don't get paid. But when they return to work, they get whatever they were supposed to be paid. This time around, the administration has said that potentially these furloughs will turn into actual layoffs. And so we could see a big effect on October labor force participation and potentially also an increase in the unemployment rate, anywhere from 0 to 0.3 of the unemployment rate. And additionally, we know that on October 1st, well, actually September 30th, you had roughly 150,000 government workers who effectively retired. And so we're going to see these numbers show up in the October data once we get it.
Why, Dana, it's interesting. The labor market is cooling, Dana, but GDP seems to be hanging in there. It's an interesting divergence. How do we explain that?
Well, I'd say that you have to look underneath the surface. And when you look under GDP, in the first half of the year, domestic demand continued to slow. And most of the action we saw was companies and people stockpiling and buying ahead of tariffs and then running those stockpiles down, and you're not going to go out and buy a second car. But with the labor market, I don't think it's as weak as many people say. Yes, there's not a lot of hiring, and that shows up in payrolls, but there's not a lot of firing either. Many companies are just on hold. They're watching, they're waiting to see what the tariffs deals look like. They also early in the year want to understand what taxation and regulatory and spending policy from the federal government would look like. And certainly when you're in a shutdown, you're not going to do much. You're probably just going to continue to wait. And the unemployment itself is really quite low, but there are definitely risks that it could rise. And then I think people also forget about income. Most people are still working and you get income, and wages are rising not as rapidly as they were a few years ago when we had severe labor shortages, but they're still rising at a pace that's above what we saw between the great financial crisis and the pandemic. And indeed, when we ask consumers, what are you worried about? They are worried about the labor market, but then they say they're not worried about their personal finances, which includes income as well as gains they may get from financial assets.
That's interesting. Final question, Dana. You have this shutdown. Without government data, what does that mean for the Fed, Dana? What could it mean for that Fed meeting next month?
I know what markets are saying, that the Fed's going to go ahead and cut, but Chair Powell has said that the Fed is data dependent, right? They're trying to be preemptive, and they did that with a first cut. But now that they don't have data, they can't be data dependent if there's no data. They can look at alternative sources, but again, a lot of those other sources are either soft data, which are opinions, doesn't really tell you what's going on in the real economy, or they're hard data, but their methodologies are very different from the way that government data are structured. And so they might not feel comfortable making any sudden moves or doing anything until they know that they have the data in hand.
Dana, great to have you on the show today. Thanks so much for your time.
Thank you.
Coming up, billionaire Jeff Bezos says an AI bubble is a good thing. We'll explain it more when we come back. Stick with us. Jeff Bezos is making some strong comments to drum up optimism around AI. Our tech editor Dan Howley is here with more. Dan.
Bezos was at Italy Tech Week, or Italian Tech Week rather, and talking about the AI bubble and the discussion of the kind of frothiness and hype around the AI trade. And really, he kind of tried to hammer home a few points. One, he said that, yeah, there is an AI bubble at this point. He had specifically talked about a company that had 6 people but managed to raise billions of dollars at a $20 billion valuation. He didn't say exactly what that company was in particular, but did say that that's an issue. And something that is seen in times like this, where you see good companies and bad companies, good ideas and bad ideas get funding at times like this. But he also said that AI is a real kind of capability and something that will continue to grow and show real productivity gains in the future. So it's not as though this is kind of a vaporware scenario where, people are investing and waiting and well, it just doesn't show up. He believes that this is something that's going to boost companies and change businesses around the world. It's just a matter of which companies end up doing that and which don't. And he pointed out, the likes of OpenAI and Anthropic. And this has been, kind of an ongoing discussion we've seen at the same conference. Goldman Sachs CEO David Solomon had said that, there seems to be an AI bubble at this point, but pointed out that just as Amazon in particular gutted it out during the kind of pop that happened in the internet after the internet bubble, there will be companies that will gut it out as well with the AI bubble. And so it's just a matter of how many people do believe that this is a bubble, and if it is in fact a bubble, when does that pop?
All right, Dan, thank you. Appreciate it. Well, this week, the U.S. government went into a shutdown and Wall Street seemingly shrugging it off. Yahoo Finance's Allie Canal taking a closer look with the investor playbook. Allie.
Hi, Josh. Yeah, investors don't seem all that concerned with the major indexes continuing to notch record highs. Wall Street is leaning on momentum, AI optimism, and continued expectations for further Federal Reserve easing. Now, the rally has been led by large cap tech, and it comes even as Washington gridlock delays critical economic data, including the September jobs report. Now, without those figures, both investors and the Fed are essentially flying blind here, turning instead to private sector readings like ADP and JOLTS, which do point to a sharper slowdown in the labor market. And as questions mount about what to do next, some strategists told us that the best move may be no move at all. Here's more of what they had to say.
Investors should just ignore that and pick great companies or great ETFs or index funds and just leave it alone and do as little as possible. I think that it's counterintuitive that I think investors, the less they do, the better. Just get your allocation right, get it in place, and just forget about it and go live your life.
I called it the Spider-Man market in regards to the wall of worry. We're just clambering up there. There's a certain amount of nihilism, actually, almost, that just all news is good news and no news matters. And so you can argue that by not getting this piece of news, that's one less impediment in the market, in the market's relentless rise.
The longer the shutdown goes on, the less economic activity there is. The greater the risk is that we have a downturn in the economy, or at least a much softer economy in the fourth quarter. And that could lead the Fed to cut twice rather than the one time that we expect.
So you're hearing right there from Kathy Jones, head of fixed income at Charles Schwab, that for the Fed, the shutdown can be a real pain point, especially as it juggles both sides of its dual mandate. And that pressure only grows the longer that this drags on. But as George C. and Steve Sosnick pointed out, investors aren't necessarily facing that same kind of stress. The message from them is simple: stay disciplined, stay invested, and don't overreact to the headlines. Now, that doesn't mean stocks can't reverse course or that volatility won't pick up. In fact, George told me that markets don't go up forever, but at least in the context of the shutdown, investors can afford to sit tight here, Josh. So that's the general messaging that we've been getting.
All right, thank you, Allie. Appreciate it.
Yeah.
Now time for today's trending tickers. Yahoo Finance's Allie Canal still here with me. We're going to take a look at Netflix, Occidental Petroleum. Maybe we'll talk a little Bumble. We're going to start off with Netflix. Stock headed for a downbeat week following Elon Musk's calls for a boycott of the platform after joining in on criticism of its animated show Dead End Paranormal Park. So this one, Allie, so Musk is posting about canceling his Netflix subscription. You had Robbie Starbuck, well-known conservative activist. He's out there on this. I mean, not what you need if you're Netflix, not what you need if you're any company, really.
Right, and this has been going on for a few days now, something that we've been talking about. Netflix is on track to close the 5-day period down 5%. At one point during the lows of the session today, we were on track to have the steepest weekly loss since April. We have since come back from some of those losses here. But like you were just saying, I mean, Elon Musk telling his 227 million followers on X to cancel their subscriptions. He's been continuously posting about it. It's making noise. Netflix hasn't commented on the backlash, and analysts overall have been bullish. We just saw Oppenheimer reiterate their outperform rating. They continue to see further tailwinds for this company as they double down on ads, live sports content. They have a lot of that marquee programming still to come towards the end of the year. And the stock has just been such an outperformer this year. I mean, despite the volatility, we still have shares that are rising 30% since the start of the year. We are trading well above $1,100 a share. We'll be getting earnings from this company later this month, so we'll see that update. But as a reminder here, Netflix does not report quarterly subscriber figures any longer, so it will be a bit more tough, I guess, to size any impact from this controversy.
Yeah, I mean, it's, you know, I'm not minimizing it. I mean, when Elon Musk is going after you, but I'm still trying to understand and maybe get my head around what you're supposed to do as an investor about it, right? Yeah, like you mentioned Oppenheimer's, you know, that's Jason Helfstein over there, and Jason's been doing this a long time. And, you know, to his point, he reiterated the outperform. He emphasized his clients what he called strong Q3 engagement data. But I guess to your point, we'll wait and see. Yeah, and Netflix has been in controversial situations before. Back in 2020, I reported on their Cuties controversy. So this was a French film. It faced, criticism over sexualizing children, and the stock took a little bit of a hit. And there was that cancel Netflix trending on social media, but they weathered that storm and just continued to climb higher from there. So it feels like this is just a short-term blip for them. All right. We'll see. Turning now to Occidental Petroleum. Let's look at that name. That stock getting an upgrade over at HSBC, Securities, and Mizuho. So this one, Allie, Mizuho actually upgraded the energy company. They're going to outperform. This is coming after Warren Buffett's Berkshire Hathaway agreed to buy the company's petrochemical business for around $9.7 billion. They say, which is expected to close in the fourth quarter. Folks looked at this and actually thought, well, maybe the Oracle back on the hunt, right? The analysts saying Occidental, this unfetters the balance sheet, target to 60. Yeah, that comment unfettering the balance sheet, giving Oxy more flexibility to focus on its core oil and gas businesses. The price target was also raised to $60 from the prior 58, and HSBC on board as well. So we're seeing a lot of this optimism. Now, it is interesting from the Berkshire side of things. This Occidental chemical unit purchase, $9.7 billion. You mentioned some were talking about, Warren Buffett, maybe he wants to put that record cash pile to work. Is he back on the hunt? But we were talking about this with our head of news, Miles Udlin, and he was saying, Buffett's out very shortly. Yeah. This might be a new era for Greg Abel, who is going to take over at the helm of that company. And what is Berkshire without Buffett? And what does the M&A activity look like? What's going to be the outlook for Berkshire now with Greg Abel in that top position? And that's an overarching question, I think, for Berkshire Hathaway shareholders moving forward. And this Oxy purchase maybe is the start of that regime. Yeah, Miles, by the way, kind of my go-to guy. He knows a lot about Buffett. About Berkshire. He's been following Buffett for a while, following Berkshire for a while. He's been to those meetings, so I trust his commentary. Total pro. Lastly, Bumble gets hit now. This with a downgrade over Goldman, lowering its rating on that stock. From buy, they go to neutral, so moving to the sidelines, Allie. This is Eric Sheridan, well-known guy. Current estimates could reflect that visibility into a turnaround of the core Bumble app remains low, likely not until mid-2026. Target set to 7. Stock is down nearly 30% this year. Yeah, just brutal year-to-date run for this stock. You're seeing the reaction today, down 3%. The Goldman cutting that rating to neutral from buy, warning that the turnaround for the core app could take time. Don't see growth really picking up until mid-2026. $7 price target. Bumble's already down, as you said, significantly year-to-date. It just feels like there's not a lot of momentum. And I know, Josh, you're not on these apps. No. Unfortunately,
unfortunately, I have dabbled, and it's just not good. It's not good out there for all these apps. They make you pay for anything worthwhile. I don't feel like doing that. The quality is just not there for me. So as a user, I'm a bit disappointed. So I can understand how investors could be disappointed
Users
as
and
well.
investors disappointed.
Yes.
Oh, good. Thank you, Alan. Appreciate it. Coming up, AI may be the determining factor over whether you'll be saying that's a good buy for a stock or bidding it goodbye from your portfolio. An expert picker is diving into 2 stocks. Stick with us for that after the break. Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves to your portfolio. I'm here today with Ben Connard, Carnegie Investment Counsel, Portfolio Manager. Ben, it is great to see you. So we're going to start off on a name you like, Ben, and that would be Microsoft, which has had a good run already, Ben. It's up about 25% year to date. Most analysts on the street, they still like this one. You do too. So let's walk through some of the reasons why. The first reason, Microsoft 365 commercial revenue.
Sure. Microsoft has a huge base. They've got about 400 million commercial users. That provides a steady source of revenue for the company. It's pretty economically resistant. It's not going to move much. And it provides a steady cash flow for them that they can invest other places in their business.
Second point, Ben. Second reason you say this one's set up to monetize AI.
Yeah, it's actually related to the first point. With all those users, they can add their co-pilot to that, their AI agent, and they can upsell those commercial users the co-pilot. They charge more for it. They almost double the revenue per user, and so that's a big source. And then they have Copilot in GitHub, which is their software development program, and that's grown quite nicely. They're about 20 million GitHub users using the GitHub Copilot, and so it's a nice added revenue. And they're one of the few companies that are already monetizing AI.
And a third reason you'd commit capital to Microsoft, Azure cloud growth.
Yeah, Azure is their cloud infrastructure product. It's growing nicely. I think it grew 39% year over year last quarter. They are obviously providing the infrastructure the data centers need to run AI. They obviously have a relationship with OpenAI, and that's leading to steady growth. And then just in general, we still have tech companies moving their technology from on-premise to the cloud. And since Microsoft has an established relationship with a lot of companies through their legacy server business, that provides an easy guide. Be like, using us now, let's transition to the cloud.
All right, finally, Ben, before you all pile in,
yeah,
let's talk about some downside risk. Cloud business has lower margins. Walk us through that.
Yeah, in general, the cloud business has lower gross margins than their other businesses. And it's also their fastest growing business. So if you just think about that, that's going to lower their overall margins. And then the cloud business is very competitive, and it's becoming increasingly competitive with Oracle. So you already have Amazon Web Services, you have Google Cloud, and now Oracle Cloud has joined, and they're growing exceptionally well. And that competition means their margins aren't likely going higher, and that'll impact Microsoft going forward.
Let me ask you, when you look at a name like Microsoft, basically everybody likes Microsoft. 97% of analysts who are paid to give you an opinion about Microsoft, 97% have a buy. Does that ever give you any cause for concern when you see a name and basically everybody is piled on one side of the boat?
Yeah, it is, and I mean, you see it in the valuation. Microsoft's not a cheap stock right now. It's over 30 times multiple, but to us, it's still a core holding, and it should be in your portfolio. And there's still those businesses, the lines we just talked about, provide downside protection and say, yeah, let's keep owning this stock, or let's buy it.
All right, so that's one you like. Let's now talk about one you don't like as much. You'd avoid. That would be Adobe. Now, this stock is already down.
Yeah.
It's down about 20% year to date. You don't see that as an opportunity. You would still avoid Adobe. So the first reason is competition.
Yeah, so Canva and Figma, they've been around for more than 10 years. This isn't really new competition, but it's increasing competition as Adobe expands beyond professionals into non-professionals. They're running into Canva more. And so it's just something to be wary of, and the competitive landscape has changed for Adobe.
Second reason you say avoid Adobe. AI native products also a source of competition.
Yeah, OpenAI has a product. Google has some AI products that help video editing, image editing, and that's added competition. And again, it's for the non-professional users, but it erodes Adobe's ability to grow users quickly.
Finally, reason you steer clear, pricing power threats.
Yeah, it's obviously connected. Adobe, they grow revenue through more users and also increasing their revenue per user. And that is, they have the pricing power to basically increase prices. And when you have more competition, you don't have that power, and then it's going to make it harder for the company just to grow the top line.
All right, so you say avoid Adobe, but finally, Ben, walk through, how could you be wrong on this call?
Right there, Adobe, it's still the marketing standard for professionals. So they have a base that's not going to be dislodged. For a lot of professionals in the marketing space, it's part of their workflow using the Adobe products. So it's not like companies can just sweep in and take that business away. And as the chart you just showed, the stock's been hit. It's priced pretty cheaply, but ultimately we think that there's still downside because the competition is too great with the Canva Figma and then the new competition from native AI.
All right, so buy Microsoft, avoid Adobe. Ben, thanks so much for your time today and those picks. Appreciate it. And thank you all for watching. Goodbye or goodbye. We're wrapping up today's Market Domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.